Welcome to Unlocking the Investment Upside. I'm Geoff Robinson. Today we're asking a big question. What really separates great analysts from the rest? It's not just Excel skills or CFA exams, it's how they think. We're diving into a powerful 4-level framework that shows how investment analysts evolve from black and white decision-making to something far more nuanced, integrative thinking.
Geoff, this reminds me of when I was a junior analyst. Everything felt like a trade-off. Growth versus value, risk versus reward. But you're saying the best analysts don't just choose sides, they build a third way.
Investment analysis seems straightforward on the surface, spreadsheets, models, data. But what if the real difference between good and great analysts isn't their technical skills at all? It's actually how their brains process complexity. And
that's an interesting perspective. What makes you say that?
Well, I've been diving into research on how top analysts think, and it turns out there's this fascinating progression in cognitive development that perfectly maps to investment success. Think about how a junior analyst might evaluate a stock versus how someone like Warren Buffett does it.
So you're saying there are different levels to how analysts process information?
Exactly. The research identifies 4 distinct levels, starting with what they call binary thinking. It's like watching a rookie analyst react to earnings news. They see everything as either good or bad, buy or sell.
Well, that makes sense for beginners. You need those clear guidelines when you're starting out.
True, but here's where it gets interesting. Take the Meta privacy scandal a few years back. A binary thinker would say privacy breach equals sell signal. But that misses so many layers: user behavior patterns, advertising infrastructure, regulatory timelines. The market is rarely that simple.
So what's the next level up from binary thinking?
That's what they call conditional thinking, where analysts start using if-then statements like, if interest rates rise above 4%, then growth stocks will underperform. It's more sophisticated, but still pretty mechanical.
That sounds like most of the financial models I've seen. What's wrong with that approach?
Well, consider how a conditional thinker might analyze tech stocks during rate hikes. They might assume all tech stocks suffer equally, but companies like Adobe or Autodesk actually have unique characteristics, again, pricing power, low capital needs, that can make them rate hike resistant. And
so you're saying even this more advanced thinking can miss important nuances?
Exactly, which brings us to level 3, relativistic thinking. This is where analysts get comfortable with contradiction and multiple valid narratives existing simultaneously.
That sounds challenging. How does that work in practice?
Take Tesla. A relativistic thinker doesn't waste time debating whether it's a car company or a tech company. Instead, they explore how different investors assign value based on both perspectives. They understand that truth often depends on stakeholder perspective and time horizon.
That's fascinating.
Anyway, quick plug time. This episode is brought to you by Insight One, where deep market expertise meets powerful edtech. Whether you're building models or breaking mental models, Insight One helps you think like a top-ranked Wall Street analyst. Interactive courses, advanced simulations, and insights from pros who've been in the trenches. Start your journey today at theinvestmentanalyst.com or download the app on the App Store or Google Play. Sorry, Archer, sometimes I can't help myself. Now, what were you saying?
But you mentioned 4 levels. What's the highest form?
The pinnacle is what they call integrative thinking. These analysts don't just acknowledge different perspectives, they synthesize them into entirely new insights. They're like mental alchemists.
Could you give me a real-world example of that?
Picture a mature consumer staples company facing margin pressure. Most analysts debate between cutting costs or investing in growth. An integrative thinker asks, what if we could do both? Could we strategically divest lower margin units to fund R&D without hurting earnings quality?
That's really clever. Creating a third option instead of choosing between 2 alternatives.
Right, and this is exactly how Warren Buffett thinks. His famous growth is a component of value philosophy transcends the traditional growth versus value debate. He's not picking sides, he's synthesizing a new framework.
So how does someone develop this kind of thinking? More certifications?
Interestingly, no, it's much more about experience, mentorship, and deliberate practice. Some investment firms are actually building this into their culture now through structured debate sessions and exercises like red teaming.
That must have huge implications for hiring and team building.
Absolutely. Forward-thinking firms are starting to hire for cognitive flexibility over pure technical skills, because in today's complex markets, the ability to process contradiction and synthesize insights is becoming more valuable than raw analytical horsepower.
It's really about seeing the market as an evolving ecosystem rather than a puzzle to be solved, isn't it?
Exactly. The best analysts aren't trying to find the one right answer. They're developing frameworks to navigate complexity and uncertainty. They're comfortable with paradox because they understand that's where the real opportunities often lie. And
this reminds me of that quote about the mark of an educated mind being able to entertain a thought without accepting it.
That's Aristotle. And yes, that's exactly it. The market doesn't need more people who can run complex models, though that's important. It needs people who can think deeply, hold complexity, and generate novel insights from apparent contradictions.
So the future belongs to the synthesizers, not just the analyzers?
Precisely. In a world where everyone has access to the same data and similar technical tools, how you think becomes your real edge. The market's not looking for the fastest brain anymore. It's looking for the deepest one.
This has me reflecting on my own thinking patterns. I can definitely see areas where I default to binary thinking when I should be pushing for a more nuanced view.
That awareness is actually the perfect starting point. Once you recognize these different levels of thinking, you can start moving between them more consciously. It's like any skill, deliberate practice leads to improvement.
And I suppose the market itself provides pretty direct feedback when you're thinking too simplistically.
Oh, it certainly does. Nothing teaches the importance of nuanced thinking quite like being on the wrong side of a trade because you oversimplified the situation.
Well, this has completely changed how I think about what makes a great analyst.
And here's what's really exciting. This framework isn't just useful for investment analysis, it's valuable for thinking about any complex problem. Whether you're analyzing stocks or trying to solve big organizational challenges, the ability to think in layers is becoming more crucial than ever.